Hello everyone, welcome back. And it's only been one holiday trading session since silver ripped higher overnight, opened with a big gap, pulled gold with it, and forced everyone watching COMEX and Shanghai to ask the same question. Is this another false start, or is the physical silver market finally telling us something bigger is breaking underneath the surface? It's Tuesday, May 26th in New York, and before we go further, tell me in the comments what day and date you're watching from, because markets move fast, but our notes get sharper when we compare them together. And if you value this kind of work, subscribe and comment "Our John AG" below. That tells me you're part of the team that wants clean analysis without the noise. So in this video, I want to make sense of what happened with silver pushing higher, why gold also caught a bid, what the Shanghai Open is telling us about East versus West pricing, why holiday trading can create moves that look stronger or weaker than they really are, and what we need to watch next before deciding whether this is continuation, exhaustion, or just another headline-driven trap. Now, jumping in, the first thing we need to understand is that silver did not quietly drift higher. It jumped. It came into the new session with a gap, traded around the upper 70s, and immediately made the gold to silver ratio look different than it did just a short time ago. Gold rose too, but silver was clearly the louder move. And when silver outperforms gold on a day when broader US markets are closed, we have to be careful and curious at the same time. Careful, because thin liquidity can exaggerate candles. Curious, because exaggerated candles still happen for a reason. Here's the mistake most people make. They look at a green candle and instantly decide the story is bullish. Or they look at a red candle and instantly decide the move failed. We can't do that. We need to separate fact from interpretation. Fact: silver opened with strength after the prior session paused. Fact: gold also moved higher, but not with the same aggression. Fact: Shanghai pricing stayed noticeably above the Western quote, keeping the East-West spread in focus. Interpretation: that suggests the physical side of the market may still be tighter than paper traders want to admit, but it does not prove that every intraday spike must continue in a straight line. And that last part matters because we're not gambling, we're measuring. Now watch this. When US stock markets are closed for a holiday, futures can still trade, but the depth of the market is different. Fewer participants are active. Big orders can push price around more easily. That means a move higher can look dramatic, and a move lower can look like an attack, when sometimes it is simply a thinner book meeting aggressive positioning. Based on recent market updates, precious metals trading during holiday sessions has been especially sensitive to currency moves, energy headlines, and geopolitical comments. That is why we have to watch price, volume, and follow through together. Because if silver gaps up and holds, that is one message. If silver gaps up, fades, and then buyers step back in, that is another message. But if silver gaps up and immediately loses the prior breakout area, then we have to respect the possibility that late buyers got trapped. So, what happened when Shanghai came back into the picture? The Western silver price was already elevated, and Shanghai was still showing a premium, but the opening reaction was not a clean moonshot. We saw pressure. We saw the spread shift. We saw the market remind everyone that East-West arbitrage is not as simple as buying in one place and selling in another. Shipping, financing, taxes, exchange rules, delivery standards, and timing all matter. That is why premiums can exist longer than casual observers expect. And here is the clue. If Shanghai keeps paying more, the question is not just, why doesn't the spread close? The better question is, who is willing to keep paying up, and why? If industrial users, local investors, or regional dealers need metal now, then a premium becomes a signal. If the premium narrows because Western price catches up, that can still be bullish. But if the premium narrows because Shanghai weakens first, that changes the read. So over the next few sessions, we need to watch whether COMEX chases Shanghai or whether Shanghai starts refusing to lead. That is the whole game right there. Moving on to gold, the move was quieter but still important. Gold was sitting in the mid-4,000s, and while silver grabbed attention, gold's behavior gave the silver move some cover. When silver runs alone, the market can dismiss it as a squeeze, a speculative burst, or a crowd trade. But when gold rises alongside it, even more slowly, that tells us the move may be connected to broader concerns about the dollar, rates, energy, and global risk. Now that does not mean gold and silver are the same trade. They are not. Gold is the reserve asset. Silver is the monetary metal with industrial demand attached. Gold usually tells us about trust. Silver tells us about trust plus availability. And when silver starts outperforming gold while the market is debating currencies, war risk, oil, and policy expectations, we need to pay attention. Let's pause here because this is where a lot of people get pulled into bad thinking. If there is positive geopolitical news, some people assume metals must fall because fear is going down. But recently, the relationship has been more complicated. If peace hopes push oil lower, that can ease inflation pressure. If inflation pressure eases, the market may start thinking about a friendlier rate environment. And if the dollar weakens at the same time, metals can rise even when fear is cooling. So the old simple rule, war up, peace down, is not enough. The better rule is, what happens to real rates, the dollar, and liquidity? That is the part most people miss. Now we also have to talk about the so-called danger window in the morning, because traders watch those early bursts for a reason. There are periods when liquidity changes, when New York participation builds, when overnight positions get adjusted, and when stops can be triggered quickly. But here's the counterpoint. Not every sell candle is manipulation. Sometimes it is hedging. Sometimes it is profit-taking. Sometimes it is a dealer flattening risk after a holiday gap. And sometimes, yes, aggressive paper selling can overwhelm a thin market. The point is not to label every move. The point is to identify whether the selling has power after the first push. If sellers hit silver and price refuses to break down, that is useful. If buyers defend higher lows during a thin session, that is useful. But if the market needs constant hype just to stay green, that is a warning. So we watch the reaction, not just the move. Now, the second big story today is counterfeit silver, and this matters more than people think. Recent testing of silver coins bought through major online marketplaces found multiple fakes that looked convincing enough to fool casual buyers. Some pieces had the right shine, the right design, and the right weight feel, but the metal content was not what buyers thought they were getting. This is why we never confuse stacking with clicking buttons. A cheap price is not a strategy. A trusted relationship, verification, and patience are part of the strategy. If silver is rising, scams rise with it. If mainstream interest comes back, fake listings multiply. And if new buyers rush in without testing, that creates damage not just for individuals, but for trust in the whole physical market. So here's the question I want you to answer below. Are you buying only from sources you can verify, or are you chasing the lowest price because the candle is green? There is no shame in wanting a deal. We all want a deal. But if the deal is too good, we have to ask what we are actually buying. A real ounce at a fair premium beats a fake bargain every single time. Now moving on to the bigger macro backdrop, the debt conversation is getting louder again. Some high-profile investors are warning that U.S. debt levels and future deficits could keep pressure on the dollar over the long run. We do not need to accept every dramatic price target to understand the basic point. When debt expands faster than productive capacity, the currency question never really goes away. It may get quiet for a season, but it does not disappear. And this is where gold and silver sit in a different category than most assets. They do not have earnings calls. They do not promise growth. They do not pay interest. They simply stand outside the credit system. That sounds boring until confidence starts moving. Then boring becomes useful. From recent market updates, we also know the repo and funding markets are being watched again. Small movements there are not automatically a crisis, but they can tell us when banks are managing liquidity more carefully. Think of it like a pressure gauge. One small flicker is not a fire. Repeated flickers deserve attention. So if metals are rising while liquidity signals get noisy, we do not panic. We observe. One more thing needs to be said about the closed stock market. When equities are shut and futures are still moving, headlines can punch above their weight. A post, a rumor, or a small order can move price more than it normally would. So we do not crown a new trend during thin conditions. We wait to see whether real volume confirms it. That confirmation is the difference between a tradable signal and a pretty candle that disappears by tomorrow morning. And that difference can save us money. Now, oil is another part of today's puzzle. Crude moved sharply lower as markets reacted to headlines around possible progress in the Middle East. That matters for metals because energy feeds inflation, inflation feeds rate expectations, and rate expectations feed the dollar. Lower oil can sometimes cool the fear trade, but it can also support metals if traders believe central banks will have more room to ease or at least stop tightening conditions. So again, the market is not moving on one headline. It is moving on the chain reaction after the headline. And that brings us to the most important question for silver right now. Is this move being driven by real demand, or is it being driven by traders chasing momentum during thin trading? The honest answer is probably some of both. That is not a dodge. That is markets. Physical tightness can create the setup, headlines can light the match, and leverage can pour fuel on the first move. But the test comes after the excitement. If silver can hold higher levels when regular volume returns, the case improves. If it needs holiday conditions to stay elevated, we have to be more cautious. This is educational, so we manage risk. For stackers, the plan should not change just because price jumped. Dollar cost averaging still matters. Position size still matters. Verification still matters. And if you already have a strong physical base, chasing every candle may not be necessary. The goal is not to win one morning. The goal is to survive many cycles. But for traders, the setup is different. Traders need levels, invalidation, and discipline. If silver holds above the breakout zone and Shanghai continues to show demand, upside pressure can continue. If it rejects and volume fades, we could see a quick shakeout. Both can be true within the same broader bull case, and that is why we stay flexible. Now, as we wrap this up, here are the main takeaways. Silver pushed higher with more force than gold, which puts the ratio and the physical market back in focus. Shanghai remains one of the most important tells because a persistent premium says something about regional demand. Holiday liquidity can distort moves, so follow through after the holiday matters more than the first candle. Counterfeit risk is rising with attention, so verification is no longer optional. And macro pressure from debt, currency weakness, funding markets, and energy volatility keeps metals in the conversation even when headlines change. So tell me this in the comments. Do you think silver is beginning a real breakout, or do you think we still need one more pullback before the stronger move begins? And if you are part of our team, subscribe, leave a like, and comment "Our John AG" so I know you want more direct analysis like this. With that said, take care of yourselves, take care of each other, and remember, I'm not here to tell you what to buy or sell. This is for education and market discussion only. We look at the evidence, we respect the risk, and we make our own decisions with clear heads, not hype.